Welcome to The Explainer. Today, we're tracing the invisible web of the global petroleum economy. Even as we're marching toward this future of green energy, crude oil remains absolutely one of the most strategically important commodities on the entire planet. It doesn't just fuel our cars, it's literally woven into the very fabric of global trade and manufacturing. Because almost every single good produced today requires energy to make or move, any fluctuation in crude oil prices acts kind of like a stone dropped in a pond. It creates this massive economic ripple effect that eventually touches every single one of us.
So here's a mystery that hits us right in the wallet. Why does a disruption in an oil field halfway across the globe instantly raise the price of your groceries at the local supermarket? How do these massive macro-level global forces translate so incredibly fast into our everyday household budgets? Well, to answer that, we're going to follow the amazing journey of a barrel of oil right through the global economy. We'll look at exactly who wins, who loses, and how a price shock travels all the way from the wellhead straight to your dinner table.
All right, let's dive right in. The very first thing we have to establish is this massive global divide between oil exporters and oil importers. It's night and day. On one hand, when prices spike, exporting nations like Saudi Arabia or Norway experience an absolute economic boom. Their wealth funds swell up, trade surpluses expand, and they can fund these massive mega projects. But on the flip side, for importing nations, that exact same price spike acts like a heavy, unavoidable national tax. They are forced to spend way more of their foreign currency just to maintain basic energy needs, and that directly leads to trade deficits and slower GDP growth.
To put that into perspective, take India, for example. 85%. That is the staggering amount of crude oil that a rapidly growing economy like India is forced to import just to keep the country running. So, when global oil prices go up, countries like India literally hemorrhage foreign currency. More dollars leave the country simply to pay for energy, which drastically reduces the funds they have left to invest domestically in things like infrastructure, healthcare, or new technology.
Now let's flip the script for a second. $140 million. For a major exporter like Saudi Arabia, which moves roughly 7 million barrels of oil a day, a simple $20 increase in the price of a barrel generates an astonishing $140 million in additional daily revenue every single day. That is the kind of windfall that literally builds new cities, expands massive transportation networks, and funds major international acquisitions.
So this brings us to the core of the whole thing, the domino effect, and exactly how oil triggers global inflation. This chronological journey of inflation basically happens in 4 distinct steps. We've got direct energy, the supply chain, manufacturing, and finally agriculture.
Let's zoom in on those first 2 ripples. Stage 1 hits you immediately. Petrol and aviation fuel costs spike, and families instantly feel the pinch at the pump, causing household disposable income to just drop. Then, usually within weeks, Stage 2 kicks in. Trucking, rail, and shipping companies suddenly face massive diesel bills. So what do? They slap on massive fuel surcharges. Manufacturers pass those costs to wholesalers, wholesalers pass them to retailers, and suddenly products that have absolutely nothing to do with petroleum become way more expensive simply because the cost of moving them has skyrocketed.
And here is the absolute game changer that most people miss when we hit stages 3 and 4. Petroleum isn't just fuel. It's an actual physical raw material. It's in our plastics, our cosmetics, even pharmaceuticals. So when oil prices rise, the cost to manufacturing all of these synthetic goods surges right along with it. And in agriculture, well, farmers need diesel for their tractors and irrigation pumps for sure, but their fertilizers also rely heavily on petroleum feedstocks. When energy costs soar, food production costs soar right alongside them, pushing your grocery prices significantly higher.
So all this high-level macroeconomics, it ultimately lands right on your doorstep in what we call the Main Street squeeze. As household budgets tighten from higher fuel and food costs, consumer confidence inevitably drops. Families delay buying cars, they cancel vacations, they cut back on dining out. And in response, small businesses and corporations see their profit margins shrink. They're forced to raise prices, freeze wages, or delay their expansion plans just to survive the squeeze.
Which leads us to a massive structural problem. The central bank dilemma. It is, quite frankly, an impossible trap.
Here's the illusion of choice they face. The primary tool central banks have to fight inflation is raising interest rates, right? That slows down consumer borrowing and cools off the housing market. But here is the stark reality check about oil. Raising interest rates cannot drill more oil. It cannot lower the cost of manufacturing or shipping. So central banks risk stalling the entire economy by crushing consumer demand, while energy prices and production costs remain stubbornly high regardless.
And if central banks get caught in that trap, we face a terrifying scenario known as stagflation. Stagflation is this really rare and difficult economic environment where you have a combination of slow or negative economic growth, rising unemployment, and persistently high inflation. Normally, inflation happens when an economy is growing really fast. Stagflation is a nightmare because things get more expensive even while the economy is actually weakening. It's the exact nightmare phenomenon of gas lines and soaring prices that haunted the global economy back in the 1970s.
Now, beyond just inflation, we've got to talk about international finance, specifically the almighty dollar and currency markets.
Because crude oil is primarily traded in US dollars, energy markets essentially dictate global exchange rates. Think about how this plays out on the ground. When oil prices rise, importing nations need more US dollars just to pay their larger energy bills. That massive demand strengthens the dollar. But a stronger dollar means everything else a country imports also becomes more expensive. So it doubly punishes developing nations. Their import bills inflate, their local currency devalues against the dollar, and their central banks are forced to raise rates just to defend their currency. Now, when oil falls, the exact opposite happens. Demand for the dollar decreases, import bills shrink, and nations finally get a little breathing room to lower rates and boost growth.
Because oil carries so much economic weight, it is undeniably a strategic geopolitical asset. Wars, international sanctions, political instability in producing regions, pipeline attacks, or OPEC production decisions can all severely disrupt the global supply. And here's the really fascinating part. A disruption doesn't even actually need to happen. Just the mere expectation or even the fear of a supply disruption from global conflicts is often enough to send commodities traders into a total panic. Prices can skyrocket before a single drop of oil is actually lost.
This brings us to a huge modern paradox: why oil still matters so much in the renewable era.
Despite the awesome rise of green tech and electric vehicles, just look at the absolute backbone of global trade: aviation, maritime shipping, heavy trucking, agriculture. While it's true that producing $1 of global GDP requires far less oil today than it did 50 years ago, our most critical heavy industries and global trade networks are still entirely dependent on fossil fuels. We just can't currently fly commercial planes or sail massive cargo ships across the ocean on batteries alone.
And this exposes a massive, real fragility in our modern system, the just-in-time vulnerability. Today's global supply chains are highly optimized and tightly integrated to keep costs as low as possible. But that means they possess almost zero spare capacity. Because everything is so interconnected and running on such incredibly tight margins, even a tiny increase in petroleum transportation costs instantly cascades worldwide. It affects the price of goods absolutely everywhere, all at once.
So I'm going to leave you with this final, really vital question to think about. If everything from the food on your plate to the smartphone in your pocket relies fundamentally on the flow and price of crude oil, are we truly ready for the renewable era? While we are making absolutely incredible strides in alternative energy, the petroleum economy's invisible web still very much holds the world together. Thank you so much for joining me on this explainer today. I really hope this helps you see the macro forces shaping our world and your wallet just a little bit more clearly. Keep asking questions and keep learning.